Right now, there's a battle brewing for the future of finance, and it's a conflict that's going to decide where and how we all manage our money. We're talking about two completely different worlds competing for your wallet, and the choice we all make is going to define the next decade.
So, let me just ask you straight up, by the end of this decade, where is your money going to live? It's not as simple a question as it used to be, believe me. The choice is no longer just between Bank A and Bank B.
On one side, you've got centralized finance, or CeFi. This is the world you already know. Banks, regulators, big institutions, but it is evolving in some really surprising ways. And on the other side, you've got decentralized finance, DeFi. It's a whole parallel financial system built on the blockchain, and it operates under a radically different set of rules. Or, sometimes no rules at all.
Let's paint a picture here. Think of CeFi as a big, shiny, tightly controlled skyscraper. It's regulated, it's established, and you always know who's in charge. DeFi, though, that's more like a sprawling, chaotic, open-air bazaar. It's totally permissionless, everything's out in the open, and hey, anyone can set up a stall. Two very different worlds, and both of them want your business.
Okay, so what's the big deal? What's the appeal? What is pulling people and literally trillions of dollars towards these new financial frontiers? Let's start with a surprising twist that's happening inside the skyscraper itself.
That's a quote from JP Morgan CEO Jamie Dimon, and he's explaining how new banking regulations are actually a huge gift to a different kind of player, what we call shadow banks. These are firms, think private equity, credit funds, that act a lot like banks. They lend money, they create credit, but they get to operate outside of a lot of the traditional banking rules. And business for them is boom.
And the scale of this shift, it is just staggering. As you can see on this chart, the amount of money managed by these private credit firms has absolutely skyrocketed. It went from a pretty small base back in 2000 to over $2 trillion by 2023. This is not some small disruption, folks. This is a massive transfer of capital into a much less regulated corner of the financial world.
All right, now let's hop over to the bazaar and see what's drawing people to DeFi. The pull is really powerful. First off, the potential for huge profits, with yields that make your traditional savings account look like a joke. Second, decentralization. This idea that there are no backroom deals, no one central authority pulling all the strings. It's transparent, right? Every transaction is visible on the blockchain, and it's accessible to pretty much anyone in the world with a crypto wallet.
But, as we all know, with great reward comes great risk. And trust me, both the skyscraper and the bazaar have their own hidden dangers, even though they look completely different on the surface. There's a real paradox happening in the traditional system. The very regulations that were designed to make banks safer after the 2008 crisis, well, they had this massive unintended consequence. They pushed trillions of dollars of financial activity into that less regulated shadow banking world. So here's the crucial point. In the name of making things safer, regulators might have just moved the risk to a place where we can't see it as clearly.
Now, let's turn to the risk in DeFi. In just 1 year, users lost $1.95 billion.
Yep, that's how much money just vanished into thin air due to hacks and scams in the DeFi world in 2023 alone. This is the wild, unregulated, and often brutal downside of that open bazaar.
And these losses aren't always from some super sophisticated hack either. The most common scam is something way more direct, called a rug pull. It's exactly what it sounds like. Developers will launch a project, they get a ton of people to invest, and then boof, they disappear with all the money, pulling the rug right out from under their investors.
This all brings us to a really crucial difference between these two worlds, the mindset. The people operating in the skyscraper and the people hustling in the bazaar, well, they think about risk and reward in fundamentally different ways. They're playing two different games.
So this is the world of the bankers. It is methodical. It's analytical. Just look at this table. This is how the big banks look at their own business. They aren't just looking at revenue. They're scrutinizing every single profit margin, every return on assets for every division. Every single decision is calculated and risk managed down to the decimal point.
And then you've got the mindset in the DeFi bazaar. Research on user behavior found that for many, that powerful drive for huge financial gains just completely outweighs their security concerns. The study makes this pretty striking comparison. It's a mindset a lot like those who are addicted to gambling. This risk-seeking behavior is made even more dangerous because of a critical misconception. A lot of users are bringing their security assumptions from the traditional world right into DeFi, thinking the old tools are going to protect them in this brand new environment.
For instance, a ton of users believe that something like two-factor authentication can protect their funds from a rug pull or from a smart contract exploit, which is basically a vulnerability in the project's code. Let me be perfectly clear, it absolutely cannot. And this creates a really dangerous disconnect between how safe people feel and the harsh reality of the risks they're taking.
So where is all of this heading? Let's take a look at how these two worlds are evolving and what their next moves are going to mean for the future of your money.
The bankers in the skyscraper, well, they aren't just standing still. They've got a new secret weapon, generative AI. For decades, big banks have been held back by millions of lines of archaic, old computer code. Now, AI is acting like a Rosetta Stone, letting them translate and modernize these old systems, and that could potentially make them faster and more competitive than ever. Meanwhile, the DeFi bazaar is facing a bit of an identity crisis. When you ask the community about regulation, they are deeply divided. Nearly half are against it, worried it would destroy the whole point of decentralization and bring in taxes. But over a third of them actually want it, because they believe it's the only way to improve security and protect users. This is a fundamental conflict between freedom and safety.
Which leaves us with the ultimate question as we look towards 2030. The promise of DeFi was to democratize finance, to give access and power to everybody. But as these two worlds evolve and collide, we have to ask, is the future becoming more democratic, or is it just becoming more dangerous? The answer to that will determine where we all choose to keep our money.